A lot of homeowners right now are having a tough time selling their house. It's because of this market. This is definitely a buyer's market. We see prices going down because closed sales are down, but inventory is up over 30% in the state of Texas. That makes it a tough market to sell your home because the amount of competition you have has drastically increased. Real estate agents up until now have only had two solutions to this. First solution is just to continue to drop price, which just causes the price war in your neighborhood until everybody's dropped as low as they can go, meaning they stripped away all their equity and are selling for what they owe. Their second solution is to say, hey, why don't you rent the property for a while and wait for the market to come back? Now you become a landlord. First of all, this only works if you can rent it for more than what your payments are. Most people are not in that situation. And even if they are, that situation could change really quick for two reasons. Number one, you're immediately going to lose all your tax exemptions you have on the home, meaning your taxes are going to go up and your escrow is going to go up. You're also going to see an increase in your insurance rates as you have to switch from a homeowner policy to a landlord policy, meaning again, your escrow goes up, your total payment goes up, and that may outstrip what you can get for rent. Even if you're able to squeeze out a little cash flow, you are still responsible for all the repairs on the house. And think of the big repairs. If the AC goes out, you don't have a choice. By law, you have to fix it. And that could be a $10,000 repair you have next month. Renting is also difficult with the high turnover of tenants. Most tenants just stay a year. And then after a year, you have a vacancy and you have to find a new tenant. That could take 2 or 3 months when you're still responsible for the mortgage payments. And tenants aren't always the best people to take care of your home. And in fact, that can create huge problems with your HOA as fines ring up. And remember, HOAs can foreclose on you. And in general, what if you get tenants that just tear up the property and just stop paying? Renting may not be the best solution for you. That's where we come in. We have a much better solution that most brokerages can't do. And that is to list your house owner finance. Owner finance is a great solution to all of these problems. Instead of being a landlord, you become the bank. That has a lot of advantages. Remember those increases in taxes and insurance we talked about? No longer your problem. All those costs pass through to the new buyer. Any repairs that come up? Again, not your problem. They're the new homeowner. You're just the bank. You're no longer responsible for the maintenance of the property. You're just responsible for collecting on your loan. And the HOA? Again, not your problem. And instead of tenants, you have buyers in the home, which just means a higher quality of care for your home. Why? Because they have money invested in it. They're going to have to put down a large down payment, which is going to make them want to maintain the home and keep up with their payments. But my favorite thing about it, and why it's so great for this market right now, is you no longer have to compete on price. Instead, you're competing on terms, meaning you can still get full value of your house even in today's market. Most people could even offer better than bank terms because they already have years on their loan and a low interest rate. And no matter how you structure it, you are going to cash flow no matter what. No matter what happens with the taxes and insurance, you will always cash flow with an owner finance note. Bottom line, you're going to make way more money selling owner finance than even in a traditional sale. A lot of people think they can't owner finance because of their existing mortgage. Absolutely not true. We can structure this as a wrap-around mortgage where you're wrapping a new note around your existing note. What that means is you collect on your loan with the buyer and you still make your mortgage payments, keeping the difference. And that's the cash flow we were talking about. Sounds great. Are there any negatives? Of course there are. There's definitely downsides you need to consider. For example, versus a traditional sale, you're not going to get all your money up front. You're going to get a down payment up front. You're still going to pay your closing costs. And so it'll be less money today in your pocket, even though it's more money long term. What happens if the buyer stops paying? You may have to foreclose on them. But here's the good news about that. In Texas, we are the fastest, cheapest, and easiest state to foreclose on somebody. We understand you're going to need help with this. Don't worry, we have you covered. We're going to give you the legal support and loan servicing that you're going to need. We're going to talk about that again in a little bit. A lot of homeowners are concerned that if they sell their house owner financing, they're not going to be able to buy another house if that existing loan is still in place. Yes, that will remain debt on your credit report and can affect your ability to buy a house. But there's a number of ways we're going to help you with that. Number one is if you sell your house owner finance and you have a note, which is an asset, you're actually going to receive income to help offset that debt. That is not true with renting if you have negative cash flow. Also, by using note servicing, you're going to be able to show that a third party has been making payments on your note for the last 12 months. Most lenders will then discount that debt from your debt to income ratio consideration, and that debt is no longer concerned when buying a new house. Most homeowners can get a new loan and buy a house in about 12 months after setting up their owner finance sale. And just remember, in getting a new loan later, it's always superior to sell owner finance than it is to rent your property. So is this the right thing for you to do? It is if you want a higher sales price, if you don't want to compete on price and instead compete on terms and get the most for your house. It's great if you want guaranteed monthly income rather than negative cash flow if you rent your property. And it's great if you want to sell faster than homes are selling on the market today. And perfect if you don't want to have landlord duties of continuing to maintain the property. Is this legal to do? Absolutely. It is legal in Texas and many other states. In fact, you're about to hear from the state's leading legal expert on wraparound mortgages, Alan Ceshker. I'll turn it over to Alan.
Hey y'all, Alan Ceshker here. If you watch this video, I'm assuming that you want to learn a little bit about mortgage wraps. So I'm going to go over a general overview, but let me introduce myself first. I'm Alan Ceshker. I own the Law and Title Office and specialize in mortgage wraps since around 2004. And we close these on a continual basis, very common practice for our work. I actually had the ability to assist the legislature, the Texas legislature, in passing mortgage legislation back prior to 2022, which came into effect January 1, 2022, and pretty much has helped the industry quite a bit to formalize and legalize mortgage wraps. And so that's who I am. A disclaimer first, since this is being recorded, obviously, and an overview. I'm going to talk to you about what a mortgage wrap is, the legality of that, pros and cons, due on sale clause issues, default by buyer, how to get homeowners insurance in place correctly, escrow accounts and handling those, utilizing third-party loan servicing, and then also just a little bit about contracting. So I want to talk generally so you can maybe stop your recording because you have enough, but mortgage wrap is seller financing, and that's pretty much it. The mortgage stays in place. As I told you, there's legislation that tells us how to do this correctly. And the pros on this are seller gets to sell their property quicker, maybe makes more money, gets to cash flow. Some of the cons are the due on sale clause, which we're going to talk about, and we cure that as an issue via utilizing trusts. And then buyer default, which is a negative. However, usually for the seller, from the dollar standpoint, it's actually a positive. And then homeowners insurance, buyer's going to buy new insurance. That's simple. We had referrals for that and know how to do that. Escrow accounts, those take care of themselves, really. The wrap lender 9 times out of 10 or 99 times out of 100 already has an escrow account. We just use that same escrowing. Third-party loan servicing company, all I can say is we should use that. They collect the payments. They let us know if there's a default. They take care of making sure payments are sufficient and what have you. They can also alert us if there's a default. And then contracting is fantastic and simple. A mortgage wrap contract is going to be the exact same as a standard seller finance contract, and we can help you with that. So let's drill down those things if you want to. Here we go. What is a wrap? So as I said, it's seller financing, and what I say is ignore the fact that the mortgage is not being paid off. We're going to take care of all of that for you, but for definitional purposes, that mortgage is not paid off and stays in place. The property is conveyed. It's not a lease, purchase, option, contract for deed, or anything of that nature. The buyer is the buyer and owner of the property. The seller just now becomes a lender in regard to this transaction. Some terminology you talk about, we're talking about either qualified or non-qualified assumption. The legislature, when they passed their legislation, said we do not have to disclose that we're conducting a mortgage wrap transaction. When I say we, buyers, sellers, what have you. And we don't have to get their authorization for this. So they clarified that completely. A qualified assumption is when the lender is involved. Those don't occur much anymore. And a non-qualified assumption, the one that we all do now, is we're not getting authorization from the lender. They're not involved in this. I do have to go over what assumption means versus wrap, because there is a difference. An assumption is when someone takes over the exact amount of the mortgage and the seller is not owed any more money, while a wrap is a bigger mortgage wrapping around a smaller mortgage, and that seller is staying involved and they get a monthly cash flow. I use the term wrap for everything because an assumption, for all intents and purposes, and from the legal documents that we draft up, is exactly the same. You're likely doing a mortgage wrap transaction, but I want to let you know assumptions are possible in the sale of property also. So is it legal? That one's easy. Yes, unequivocally, it is legal. And I'm very happy that the legislature got involved and passed their legislation telling us how to structure this. That went into effect January 1, 2022. So all of the rules, regulations, how to structure, what you have to do, disclosures is handled by the legislature telling us about that. But we've got you covered on that part. You can go out there and read the legislation if you want to. It's fantastically interesting information. But the bottom line, as I've said, is this is a don't ask, don't tell transaction pursuant to the statutes, does not require disclosure, does not require authorization. All right, pros and cons of wraps. So pros, this helps a seller. If you have a distressed seller or motivated seller, the market obviously sometimes is fast, sometimes slow. In a slow market, it allows for sellers to have a lot more eyes on their property and can sell more quickly. If it's a distressed seller and they're in a foreclosure, they can avoid foreclosure. Sellers need to cash flow. They're going to make more money now from the sale of this property. It's not going to be just that one-time dollars at time of close. They get more dollars monthly as long as the mortgage wrap loan is in place. Usually seller finance properties can sell for a little bit higher sale price. You can use, well, strike that. You're probably going to sell it quicker because now you have all eyes on your property versus just the conventional lender buyers. More potential buyers for those sellers, as I've said, and then help the wrap buyer avoid a high interest rate. So interest rates are around, bounce around between 6.5 and 7.25. You can go over there to list your property for 4% if you want to, and you're going to get a lot more interest in your listing. And then you're also going to have reduced closing fees versus a conventional lending buyer. And you're going to have a much quicker close. We're closing our mortgage wrap transactions in 7 to 10 business days versus 30 to 45 when there's a lender involved. The cons, we talked a little bit about this, the due on sale clause, and we're going to drill down into that. Defaulting buyers, we're going to drill down in that. You're married to the seller. The buyer and the seller are married together for the life of the wrap loan, and so that's possibly a con for us to consider. Your insurance may cost more, and we're going to talk about that also. And you should also incur a cost of an RMLO, residential mortgage loan originator. They confirm ability to repay and the creditworthiness of the buyer. And the more complicated transactions, thus you're listening to me, an attorney who specializes in this, explain how they are done. And then you have higher education requirements because of that complexity. I say if you're doing things right, everyone needs to be 100% educated on what this transaction is. Now let's talk about the due on sale clause. It is the right for the lender to call their note 100% due if their property is sold. So it kind of sounds like a deal killer, but it's not. A statute exists that allows us to deed our property, our homestead or otherwise, over to a trust, our trust, and that doesn't violate the due on sale clause, or actually, that's more accurately state, it specifically says a lender can't call it due. And so it avoids that. We're utilizing that trust vehicle to prevent a due on sale clause issue, and thus far, no one has ever attacked our trust. If they do want to test our trust, we have steps that we're going to put into place that are going to prevent a property from being foreclosed on, even if there's a problem. This trust is not an estate planning trust, or it doesn't protect us from liability. I call it a due on sale trust, so you need to understand that. And like I said, it's never been challenged, and if it is, we have you covered in that event also. What happens if the buyer defaults? So the seller has a right to go and recover that property in the exact same manner that Wells Fargo does. They can go and pursue foreclosure, non-judicial foreclosure. Texas is a very, very fast foreclosing state. You can get everything completed in as short as 42 days. So we have that. The seller is going to be able to keep in the event that there is a foreclosure or recovery of the property, the seller's going to be able to keep all that down payment. So while a buyer defaulting is a negative, as I said, there is a financial benefit to the seller in that they get to keep that down payment, all the payments that were made, and then go and sell the property again and get another down payment. So dollar-wise, it's not bad for the seller side of things. And then we also provide a deed in lieu of foreclosure if the parties want you to let us know if you want that. And that allows the seller to avoid foreclosure completely. And there's a deed that's held in escrow in the event of default by X number of days, 45 days, 60 days, what have you. You instruct either the third-party loan servicing company or our office to record that deed, and now the property returns automatic. Homeowners insurance, a little bit of a complexity here. The seller is going to cancel their insurance. In order to insure a property, you have to own that property. So the buyer is going to buy new homeowners insurance. The insurance has to be done correctly. If it's not done correctly, if the declaration page is sent over there to the lender and it's not done correctly, they're going to reject that. They're going to put forced place insurance on there. That costs 200 to 300% more than normal insurance. So it's going to usually create a default and the mortgage wrap explodes and doesn't succeed. So we have to use one of our 4 vetted insurance agents. They've proven they know how to do this correctly. Just reach out to us and we'll send you the information for those insurance providers. In my sale, via a seller finance rep, I put in the contracting, you must use person A, B, C, or D in order to buy this property. So it is near mandatory. We're not going to be able to vet your agent and teach them how to do this. I'm not an insurance agent and I can't do that. So it's just best practice to use one of those an escrow account. So the great majority of loans have an escrow account where you're paying 1/12 of the annual taxes and 1/12 of the insurance, the homeowner's insurance each month. If there is an escrow account, then we're going to mimic that. The one issue that we run into is your new insurance, you're going to pay for that the entire year at time of close, and then you're going to start putting escrow into the escrow account. So there's going to be a little bit of a surplus. That surplus will get released over to the buyer when they do an escrow analysis or escrow adjustment, or when the loan's paid off. So the buyer will get back those extra dollars. If there's not an escrow within the third-party loan servicing company can step in and handle collecting those escrows and issuing payment to taxes and payment to the insurance provider. So let's talk about third-party loan servicing company. We've mentioned them quite a bit. It is suggested for the buyer and seller to agree to use a third-party loan servicing company. And what that is, the loan servicer is going to receive the full payment from the buyer, and then they will disperse the payment to the wrapped lender, and then any overage will go over to the seller on a monthly basis. And so the third-party loan servicing company needs access to that wrapped lender, and so you'll provide them that access as the seller, and then they monitor everything. If there is a late payment or a non-payment or what have you, then the seller is immediately notified. So contracting, you fortunately can make this easy. We have a cheat sheet that we can send out to your real estate agent, and goes over the steps in this, and we also assist all parties in regard to filling out that 1 to 4 contract. So that one's quite easy. Again, a seller finance wrap, the contracting is 100% the same as just a straight seller finance contract. So it should be easy for you smart agents out there, but we are there to help you. There's our contact information. Get with your agent if you have additional questions or need to schedule a time to speak with us via telephone or Zoom. Appreciate you.
Hopefully you understand now that this is a legal and safe way to sell your house. And here's the bottom line. In this market, it's the best way to sell your house. It will get you the most money, the least hassle, and it will allow you to sell quickly and move on with your life. And you want to see what that means dollar-wise? We're happy to show you. We'll show you a chart just like this for your particular home. This is the last seller financing deal we just did. Look how much more money the person is going to make versus if they had sold their home traditionally and had to drop price. I think you can see now, though StepStone Realty is a brokerage and Alan Ceshker and the Ceshker Group is your closing agent, you have one powerful team on your side. We provide everything you're going to need for a successful transaction. and we're going to be there throughout the life of a loan. We're going to help you make more money and do it legally and safely. So how do you get started? It's super easy. Just contact the agent that sent you this video and they will give you a free consultation and give you all the details and the numbers that fit your house and your situation. I think it's time you find out if this is right for you.